90% of retail traders lose money. You've probably heard that stat before. But nobody tells you why. It's not because they're bad at reading charts. It's not because they picked the wrong pairs. It's because they completely ignore the one thing that actually keeps traders alive in this market: risk management. The boring word that most beginners skip past. And that single decision, skipping it, is costing traders thousands of dollars every single month. Here's what I'm going to give you today: 3 specific risk management mistakes that most traders make. Without even realizing it, I'm going to show you exactly why these mistakes happen in your brain. And I'm going to give you the precise fix for each one. By the end of this video, you'll have a risk management system that most traders spend years trying to figure out. A system that protects your account on your losing days and grows it on your winning ones. This is not theory. This is what actually works. Let's go. Trading without a stop loss. The most expensive habit in Forex. Let me tell you about Kamran. Kamran is 31 years old. He's been watching trading content for about a year. He reads charts. He understands basic market structure. He knows what support and resistance mean. On paper, he's educated. Kamran opens a trade on GBP Fallish USD. His analysis says the pair is going up. He enters. The trade starts moving in his direction. He's up 40 pips. He feels great. He doesn't place a stop loss. Why? Because he thinks the trade is going to keep going. He doesn't want to get stopped out too early. Then the market reverses. Kamran watches his 40-pip profit disappear. Now he's at 0. He still doesn't close. He thinks it'll come back. It always comes back. It goes further against him. He's now down 60 pips, then 100 pips, then 180 pips. He's frozen. He can't close, because closing means accepting the loss, and his brain refuses to do that. 3 days later, the trade gets margin called. His account loses 60% in a single position. One trade, no stop loss, no exit plan, total disaster. This is not a rare story. This happens every single day to thousands of traders around the world. And almost all of them will say the same thing afterward: I knew I should have had a stop loss. So why does someone who knows they should use a stop loss not use one? It comes down to something called the sunk cost fallacy. Once you're in a losing trade, your brain doesn't want to close it, because closing it makes the loss real. As long as the trade is open, there's still hope. Your brain holds on to that hope even when the evidence says the trade is wrong. There's also a concept called pain aversion. Clicking that close button and seeing a red number, your brain registers that as actual pain, similar to physical pain. So you avoid it. You scroll away from the chart. You check your phone. Anything to not have to look at the loss directly. And then there's the it'll come back trap. The market sometimes does come back. And when it does, you feel like a genius. You got lucky once. And that one lucky time trains your brain to keep doing the wrong thing. It reinforces bad behavior with occasional rewards. That's actually more addictive than consistent rewards. It's the same psychology behind slot machines. So what's the fix? How do you break this pattern permanently? Simple rule: no stop loss, no trade. Full stop. Before you click buy or sell, your stop loss is already placed, not after. Not I'll set it when I see where it goes. Before. This is non-negotiable. Here's how to place your stop loss correctly. You're not guessing a random number. You're placing it at the level where your trade idea is officially wrong. If you think GBP/USD is going up because it bounced off a key support level, your stop loss goes just below that support. Why? Because if the market breaks below that support, your trade idea is no longer valid. You're not right. And staying in a trade where you're wrong is the most expensive thing you can do in trading. Here's another thing most traders get wrong about stop losses. They move them. The trade goes against them, and instead of letting the stop loss do its job, they move it further away. I'll give it just a little more room. That's not risk management. That's gambling with extra steps. Your stop loss is your promise to yourself. If the market proves me wrong, I will exit immediately and move on. That's discipline. That's professionalism. That's what separates traders who last from traders who disappear after 3 months. Cameron eventually came back. New account, same market. But this time he had a rule. Every single trade had a stop loss placed before entry. No exceptions. His first month back, he had 5 losing trades and 4 winning trades. But because his stop losses capped his losses, he ended that month only slightly down. The month after, he was profitable. Not because he got better at analysis, because he stopped letting his losers run. Are you placing a stop loss on every trade right now? Every single one? If not, that changes today. No stop loss means no trade. Place it before entry, at the level where your trade idea is wrong. Never move it further away. Risking too much to recover fast. The desperation trap. Meet Anna. Anna has been trading for 5 months. She started with a $2,000 account. She was disciplined at first. She risked 2% per trade. Things were going okay. Small wins, small losses. But she was learning. Then she had a rough week. She lost 4 trades in a row. Nothing dramatic, about $160 total. But she felt behind. She felt like she needed to catch up. She thought, if I just risk a little more on the next trade, one big win and I'm back to even. So she put in 15% of her account on one trade, $300 at risk. The trade lost. She was now down $460 total. Panicking, she did the same thing again, 20% at risk this time. Lost again. In 2 trades, she had lost over $750. Her account was down more than 37% from a losing streak that started as a manageable $160. How did a small losing streak turn into a catastrophe so fast? Because she changed her risk to recover fast. And that decision turned a recoverable situation into a devastating one. Why it happens? This mistake comes from something called the recovery trap. After a losing streak, your emotional brain takes over from your logical brain. You stop thinking about managing risk. You start thinking about the money you lost. You become obsessed with getting back to where you were, and getting there fast. There's also a concept called mental accounting. Your brain separates its money into mental categories. The $160 you lost doesn't feel like your current money. It feels like money that belongs to you that someone took, and you want it back immediately. That urgency drives reckless decisions. And here's the cruel math that nobody explains clearly enough. If you lose 50% of your account, you need to make 100% just to get back to where you started. Lose 37%? You need to gain 59% to recover. The math works brutally against you when you try to recover fast. The more you try to speed up recovery, the deeper the hole gets. So what actually works? How do you recover from a losing streak the right way? After a losing streak, you do not increase your risk. You decrease it. I know that sounds backward. But here's the logic. After a losing streak, your confidence is shaken. Your emotional state is off. You're not in your best trading mindset. This is exactly the wrong time to take bigger risks. Here's the rule. After 3 consecutive losses, cut your position size in half. If you normally risk 1% per trade, you now risk 0.5%. Why? Because you need to keep trading. You need to rebuild your confidence, but you need to do it in a controlled way. Small wins rebuild your mindset. They get you back into a positive emotional state. And from that state, you make better decisions. Think of it like recovery after an injury. You don't go back to the gym and lift maximum weight the day after hurting your back. You start light. You rebuild. You progress. Trading works the same way. There's also something called the asymmetry of recovery that every trader needs to understand deeply. Write this down. If you risk 2% per trade and you lose, you need to make 2.4% to recover. That's almost even. But if you panic and risk 20% and you lose, you need to make 25% to recover. The larger the loss, the harder the recovery. That's not a motivational statement. That's the actual mathematics of percentages. The traders who survive long-term never think about recovering. They think about continuing. The money from yesterday's loss is gone. Accept it. Today is a new session, new opportunities. Same small risk, same process. That mindset, that acceptance, is what separates consistent traders from emotional ones. After your last losing streak, did you increase your risk to recover faster? If yes, you now know why that made things worse. And you know exactly what to do instead. Anna came back. She took 2 weeks off from trading completely. She journaled. She reflected. When she returned, she dropped her risk to 0.5% per trade. Her first 2 weeks back were slow, but she built momentum. She got her confidence back. By month 2, she was trading at 1% again, and this time she was profitable. Not because she found a better setup, because she stopped trying to rush recovery and started trusting the process. After a losing streak, cut your position size in half. Recovery comes from rebuilding confidence slowly, not from risking more to get back faster. Ignoring the risk-to-reward ratio. Winning trades that still lose money. Let me introduce you to Robert. Robert is actually not a bad trader. His analysis is solid. He wins about 60% of his trades. Out of every 10 trades, he wins 6 and loses 4. By any reasonable measure, that should mean he's profitable. But at the end of every month, Robert looks at his account, and it's either flat or slightly down. He can't figure out why. He's winning more than he's losing. Shouldn't that mean profit? Here's the problem. Robert's winning trades average about 20 pips. His losing trades average about 60 pips. So let's do the math together. 10 trades, 6 winners at 20 pips each, that's 120 pips gained. 4 losers at 60 pips each, that's 240 pips lost. Even though he wins 60% of the time, he's losing 120 pips net every 10 trades. He is literally losing money while having a 60% win rate. How is that even possible? Because his risk-to-reward ratio is completely backwards. He's risking 3 to make 1. That is the opposite of what profitable trading looks like. Why it happens. The risk-to-reward problem happens for 2 specific psychological reasons, and most traders don't even realize these biases exist inside them. The first reason, profit panic. When a trade moves in your direction and you're sitting on a profit, your brain immediately starts worrying about losing it. What if it reverses? I should take the profit now. So you exit early. You grab 20 pips when the trade had the potential to go 60 or 80. You're cutting your winners short because your brain is afraid of watching profit disappear. The second reason, loss hope. When a trade goes against you, your brain doesn't want to accept the loss. It might turn around. Let me give it more room. So you move your stop loss further, or you just let it run. Your losers get bigger and bigger because you keep hoping they'll reverse. So profit panic cuts your winners short, and loss hope lets your losers run long. The result? Small winners, large losers, a negative risk-to-reward ratio, and a slowly declining account, even with a decent win rate. Can you see this pattern in your own trading? Most traders, when they look honestly at their journal, will find exactly this. Their average winner is smaller than their average loser, and that one fact explains most of their financial frustration in this market. Minimum 1-2 risk to reward. That is the baseline. Non-negotiable. For every dollar you risk, you must be targeting at least $2 in profit. No exceptions. Let me show you what this changes. Same Omar. Same 60% win rate, but now with a 1-2 ratio, 10 trades. 6 winners at 40 pips each, 240 pips gained. 4 losers at 20 pips each, 80 pips lost. Net result? Positive 160 pips. The same trader, the same analysis, the same pairs. Just a different relationship between risk and reward. The math is completely transformed. And here's something even more powerful. With a 1-2 risk to reward, you don't even need to win 60% of the time. You can win only 40% of your trades and still be profitable. Think about that for a moment. You can be wrong 6 times out of 10 and still make money. That's the math working for you instead of against you. Now, how do you actually apply this? Here's the practical process. Before you enter any trade, you identify your entry point, your stop loss, and your target. Calculate the distance to your stop loss in pips. Your target must be at least twice that distance. If the math doesn't work, you don't take the trade. Simple as that. And here's the key discipline that makes this work. You don't touch your target. Once you've set it based on your analysis, you leave it. You don't exit early because you're nervous. You don't take half profits at a random point. You define the plan before the trade. You follow the plan. You trust the process. But what if the market gets close to my target and then starts reversing? That's your emotion talking, not your system. Your system said, target is here. Your job is to honor that decision, not renegotiate it mid-trade when fear kicks in. There's one important exception. If the market structure changes dramatically, if a major news event happens, if a key level is broken unexpectedly, then reassessing is fine. But the candle looks scary is not a valid reason to exit early. That's profit panic. And profit panic slowly bleeds your account dry. Omar made one change, just one. He started drawing his target before entering any trade. If the target wasn't at least 2x his stop-loss distance, he passed on the trade. No FOMO. No, this one is different. Just the rule. His win rate actually dropped slightly to 52%. But his account grew consistently for the first time ever. Because the math was finally working in his favor, not against him. Risk to reward is not exciting. There's no flashy chart pattern to post on social media. No guru talks about it in their highlight reels. But this one number, this simple ratio, is what separates traders who grow their accounts from traders who grind in circles for years. What is your average risk to reward ratio right now? Do you even know? If you don't, open your trading journal tonight. Calculate it. Because that number will tell you more about your trading than any chart ever could. Minimum 1-2 risk to reward on every trade. Set your target before you enter. Never exit early because of emotion. Let the math work for you. Okay, let's bring today together. 3 risk management strategies that 90% of traders ignore, and 3 exact fixes that will change how you trade starting today. First, the stop-loss rule. Every trade needs a stop-loss before you enter. Not optional, not I'll set it later. Before entry, place it at the level where your trade idea is wrong. And once it's set, leave it. Never move it further away. Never give it more room. Your stop-loss is your exit plan. Honor it every single time. Second, the recovery trap. After a losing streak, your risk goes down, not up. Cut your position size in half after 3 consecutive losses. Rebuild your confidence slowly. Small wins restore your mindset. A restored mindset leads to better decisions, and better decisions lead to real, sustainable recovery. Third, the risk-to-reward ratio. Minimum 1-2 every trade, no exceptions. Your target must be at least twice your stop-loss distance. Calculate this before entering. If it doesn't meet the criteria, pass. Don't trade. Because a trade with poor risk-to-reward is not an opportunity. It's a liability. These 3 things, stop-loss discipline, recovery mindset, and risk-to-reward ratio, are not complicated, but they are hard to execute consistently, especially when emotions are high. Especially when you've just had a losing streak, and your brain is screaming at you to do something different. The traders who master risk management don't just manage their money. They manage their own psychology. That's the real skill in this market, not the analysis, not the entries. The management of yourself when things get difficult. Risk management is not the boring part of trading. It's the foundation. Without it, every strategy you learn is built on sand. With it, even a simple trading approach can generate consistent, real results over time. If this gave you value, subscribe right now. Every week, I post content specifically designed for traders who are serious about building real skills. Not shortcuts, not get rich in 30 days. Real education that actually works. And in the next video, I'm going to show you the exact psychology behind why most traders sabotage their own winning trades. We're going to go deep into the mindset side of trading, the part nobody talks about but everyone struggles with. You do not want to miss that one. Subscribe, hit the bell. I'll see you there.